Capitalism is a widely used economic system that governs how capital, wealth, and resources are distributed and earned. It can be difficult to understand the intricacies of capitalism and how it works to generate income. Even those who consider themselves financially savvy can find the subject daunting. In this video, we will attempt to decode capitalism and help you understand how money makes money. From the basics of supply and demand to investment strategies and market trends, we will explore the fundamental concepts of capitalism. Our goal is to help you gain a deeper understanding of the economic system and how it functions so that you can make informed decisions about your finances. Subscribe to our channel Escalating Wealth for more videos regarding financial education. So, if you're ready to delve into the world of capitalism, let's get started. Introduction to the concept of capitalism. Capitalism is a concept that has shaped the global economy and societies for centuries. At its core, capitalism is an economic system in which individuals and businesses operate for profit. It is characterized by private ownership of resources, means of production, and the pursuit of self-interest. In a capitalist system, the market plays a crucial role in determining the allocation of resources and setting prices through the forces of supply and demand. Competition among businesses drives innovation, efficiency, and ultimately economic growth. This system encourages entrepreneurship and allows individuals to accumulate wealth through their own efforts. One of the fundamental principles of capitalism is the concept of profit. In a capitalist society, businesses aim to generate a surplus by producing goods or providing services at a cost lower than the price at which they are sold. This profit motive incentivizes businesses to maximize their efficiency, productivity, and competitiveness. Capitalism is often associated with free markets, where buyers and sellers interact freely without government intervention. However, it is important to note that capitalism can exist in varying degrees and may be accompanied by varying levels of government regulation and intervention. Critics of capitalism argue that it can lead to income inequality, exploitation of labor, and environmental degradation. Supporters, on the other hand, believe that capitalism creates opportunities for individuals to succeed and promotes economic freedom. Understanding the role of money in capitalism. Money plays a pivotal role in the intricate web of capitalism, serving as both a medium of exchange and a store of value. It is the lifeblood that fuels the engine of economic growth and prosperity. Understanding the role of money in capitalism is essential to unraveling the complex mechanisms through which it generates wealth and creates opportunities. At its core, capitalism is an economic system characterized by private ownership of resources, means of production, and the pursuit of profit. Money acts as the facilitator, enabling the exchange of goods and services between individuals, businesses, and nations. It serves as a common unit of measurement, providing a standardized way to compare and value different goods and services. In capitalism, money is not merely a static object but a dynamic force that has the potential to make more money. This is achieved through various mechanisms, such as investment, lending, and entrepreneurship. Money is allocated to different sectors of the economy, where it is used to create new businesses, finance innovation, and fund projects that generate economic growth. One of the key features of capitalism is the concept of capital accumulation. Money, when invested strategically, has the potential to generate returns, leading to the accumulation of wealth over time. This process is driven by the pursuit of profit, as individuals and businesses seek to maximize their financial gains through various investment avenues, such as stocks, bonds, real estate, and other financial instruments. Moreover, money in capitalism is not stagnant but flows through the economy, creating a cyclical pattern of income, spending, and saving. The circulation of money fuels economic activity, as consumers purchase goods and services, businesses reinvest profits, and governments fund public initiatives. This constant flow of money creates a dynamic ecosystem where value is created, exchanged, and multiplied. However, it is important to recognize that capitalism's reliance on money can also lead to challenges and inequalities. The pursuit of profit often drives competition, which can result in wealth concentration and disparities in society. Understanding the role of money in capitalism brings to light the need for effective regulation, ensuring a fair and inclusive economic system that benefits all participants. In conclusion, money is the fuel that powers capitalism, enabling the exchange of goods and services, driving investment and entrepreneurship, and facilitating economic growth. Unraveling the role of money in capitalism offers valuable insights into how wealth is created, accumulated, and distributed within our economic systems. By understanding these dynamics, we can navigate the complexities of modern economies and work towards building a more equitable and sustainable future. The mechanics of money-making. Understanding the mechanics of money-making is essential to decoding capitalism and unraveling how money makes money. At its core, capitalism is an economic system driven by the pursuit of profit and the accumulation of wealth. To comprehend how money generates more money within this system, it is crucial to delve into the foundational principles and mechanisms that underpin the process. One key aspect is investment. By investing capital into various ventures, individuals and businesses aim to generate returns and increase their wealth. This can take various forms, such as investing in stocks, real estate, or starting a business. The principle behind investing is simple yet powerful, putting money into something with the expectation that it will grow and yield a higher value in the future. Another mechanism is the concept of compounding. When money is invested or earns interest, it has the potential to grow exponentially over time. This compounding effect occurs when the returns generated by an investment are reinvested, leading to further growth and an acceleration of wealth accumulation. Albert Einstein famously referred to compound interest as the eighth wonder of the world, emphasizing its remarkable ability to multiply wealth. Additionally, the concept of leverage plays a significant role in money-making. By utilizing borrowed funds or other resources, individuals and businesses can amplify their investment potential and generate higher returns. However, leverage also carries inherent risks, as any losses incurred will be magnified, underscoring the importance of careful analysis and risk management. Moreover, the role of entrepreneurship should not be overlooked. Entrepreneurs play a vital role in driving economic growth and wealth creation. By identifying opportunities, taking calculated risks, and creating innovative solutions, they can build successful businesses and generate significant profits. Understanding the mechanics of money-making enables individuals to navigate and participate in the capitalist system more effectively. It empowers them to make informed decisions about investments, manage risks, and leverage opportunities for wealth creation. By unraveling these mechanisms, we gain insights into the intricate workings of capitalism, ultimately leading to a deeper comprehension of how money makes money within this economic framework. The concept of capital and its significance in capitalism. To understand how money makes money in capitalism, it is essential to grasp the concept of capital and its significance. Capital can be defined as the economic resources that are used to generate wealth and create more value. It can take various forms, including financial assets, physical infrastructure, human skills, and intellectual property. In the context of capitalism, capital plays a pivotal role in driving economic growth and wealth accumulation. It serves as the fuel that powers the engine of the market economy. Capital allows individuals, businesses, and institutions to invest in productive activities, such as starting a business, expanding operations, or developing new technologies. One of the fundamental principles of capitalism is the idea of capital accumulation. Through saving and investing, individuals and entities can accumulate capital over time, which in turn generates returns and profits. These profits can then be reinvested to further expand and generate even more wealth. Capitalism also relies on the concept of capital allocation. In a market-driven economy, capital flows towards areas and industries that demonstrate the potential for higher returns. This process is driven by market forces, such as supply and demand dynamics, investor preferences, and perceived risks and rewards. Efficient capital allocation is crucial for ensuring that resources are allocated to their most productive and profitable uses, driving innovation, growth, and overall economic prosperity. Moreover, the concept of capital in capitalism extends beyond financial resources. It encompasses the notion of human capital, which refers to the skills, knowledge, and abilities of individuals. Human capital is seen as a valuable asset that can contribute to economic productivity and growth. Investments in education, training, and healthcare are considered essential for developing and nurturing human capital. In summary, capital is a fundamental concept in capitalism, representing the economic resources necessary for wealth creation and growth. It encompasses financial assets, physical infrastructure, human skills, and intellectual property. Understanding the significance of capital and capitalism is key to decoding how money makes money in this economic system. Different forms of capital: financial, physical, and human. In the world of capitalism, there are various forms of capital that play a crucial role in the process of making money. Understanding these different forms and how they interact is essential in unraveling the intricacies of how money makes money. Firstly, financial capital refers to the monetary resources available to individuals, businesses, or organizations. It encompasses cash, savings, investments, stocks, and any other financial assets that hold value. Financial capital provides the means for investments, expansion, and generating returns. Whether it's through investments in stocks, bonds, or real estate, financial capital is a key driver in the growth and accumulation of wealth. Secondly, physical capital represents tangible assets such as buildings, machinery, equipment, and infrastructure. These physical assets are used in production processes to create goods or provide services. Physical capital is instrumental in increasing productivity, efficiency, and output. For instance, a manufacturing company with state-of-the-art machinery can produce goods at a faster rate and with higher quality, leading to increased profits. Lastly, human capital refers to the knowledge, skills, experience, and abilities possessed by individuals. It encompasses education, training, expertise, and even creativity. Human capital plays a vital role in driving innovation, productivity, and economic growth. Companies that invest in their employees' development and foster a culture of continuous learning often reap the rewards of improved performance and competitiveness. These three forms of capital are interconnected and mutually reinforcing. Financial capital can be utilized to invest in physical capital, which in turn enhances productivity and generates higher financial returns. At the same time, human capital is essential in effectively utilizing financial and physical capital to maximize returns and drive success. Understanding the dynamics and interplay between financial, physical, and human capital is crucial in deciphering how money makes money in the complex world of capitalism. By recognizing the value and importance of each form of capital, individuals and businesses can make informed decisions to optimize their resources and unlock greater financial success. How money is invested and generates returns. Understanding how money is invested and generates returns is crucial in decoding the workings of capitalism. Money has the potential to grow and multiply, and this is achieved through various investment strategies. One common way money generates returns is through investing in stocks and shares. When individuals or organizations purchase shares of a company, they become part owners and have the opportunity to benefit from the company's success. As the company grows and its value increases, the value of the shares also rises, providing a return on the initial investment. Additionally, some companies may distribute a portion of their profits to shareholders in the form of dividends, further increasing the returns. Real estate is another popular investment avenue. By purchasing properties, individuals can generate returns through rental income or capital appreciation. Rental income is obtained by leasing out the property to tenants, while capital appreciation is the increase in the property's value over time. Both avenues can contribute to profitable returns on real estate investments. Additionally, money can be invested in mutual funds, exchange-traded funds, ETFs, or other investment vehicles managed by professionals. These funds pool money from multiple investors and are managed by experienced portfolio managers who allocate the funds across various assets such as stocks, bonds, and commodities. The returns generated are distributed among the investors based on their initial investment. Understanding how money is invested and generates returns is essential for individuals looking to make informed financial decisions. By diversifying investments across different asset classes and understanding the risks and potential returns associated with each investment option, individuals can maximize their capital and participate in the growth of the economy. The role of profits and dividends in money-making. Profits and dividends play a crucial role in the intricate world of money-making within capitalism. Understanding how these factors intertwine is essential for anyone seeking to decode the mechanisms behind wealth accumulation. At its core, capitalism revolves around the pursuit of profit. Profit is the surplus generated when the revenue from sales exceeds the costs incurred in producing goods or services. It is the lifeblood of businesses and serves as an incentive for entrepreneurs and investors to take risks and innovate. The pursuit of profit drives competition, which ultimately fuels economic growth and development. Dividends, specifically in the context of stocks, represent a share of a company's profits distributed to its shareholders. When a company generates profits, it may choose to allocate a portion of those earnings to shareholders as dividends. Dividends serve as a reward for investors who have purchased shares in the company, providing them with a direct return on their investment. Additionally, dividends can also increase the value of a stock, attracting more investors and potentially driving up its price. These two components, profits and dividends, form the foundation of wealth creation within capitalism. They are interconnected and influence one another in complex ways. Profits drive investment and economic activity, and dividends reward shareholders for their investment. Understanding how these elements interact allows individuals to navigate the intricate world of money-making and potentially harness its power to create wealth. Exploring the dynamics of investment and financial markets. When it comes to understanding capitalism, exploring the dynamics of investment and financial markets is crucial. These markets play a significant role in the functioning of the economy, influencing the allocation of resources and determining the growth and prosperity of businesses and individuals alike. Investment markets are where individuals, companies, and governments buy and sell financial assets such as stocks, bonds, and commodities. These markets provide a platform for investors to allocate their capital in the pursuit of returns. Understanding how these markets operate is key to making informed investment decisions and maximizing the potential for wealth creation. Financial markets, on the other hand, encompass a broader range of activities and instruments. They include not only investment markets but also markets for borrowing and lending, foreign exchange, derivatives, and more. These markets facilitate the flow of funds between borrowers and lenders, enabling the financing of various economic activities and the management of financial risks. The dynamics of investment and financial markets are influenced by a multitude of factors, including economic conditions, government policies, investor sentiment, and technological advancements. Market participants analyze these factors, along with financial data and indicators, to make predictions and guide their investment strategies. Moreover, understanding the role of financial intermediaries, such as banks and investment firms, is essential in comprehending how money makes money within the capitalist system. These intermediaries facilitate the flow of funds from savers to borrowers, channeling capital towards productive investments and generating returns for both parties. Exploring the intricacies of investment and financial markets can be a complex endeavor, requiring knowledge of economic principles, financial instruments, and risk management strategies. However, gaining a deeper understanding of these dynamics can provide valuable insights into how money is generated and multiplied within the capitalist framework, empowering individuals and businesses to make informed financial decisions and navigate the ever-evolving landscape of capitalism. The impact of capitalism on society and inequality. Capitalism, as an economic system, has played a pivotal role in shaping society and influencing levels of inequality. While proponents argue that capitalism promotes innovation, economic growth, and individual freedom, critics raise concerns about its impact on social inequality. One of the key aspects of capitalism is the pursuit of profit, which drives businesses and individuals to maximize their financial gains. This profit-driven mindset can lead to unequal distribution of wealth and resources, as those who are already financially privileged are more likely to accumulate greater wealth. As capitalism encourages competition, it often results in winners and losers. While some individuals and businesses thrive and amass significant wealth, others struggle and face financial hardships. This disparity can deepen social divisions and contribute to a widening wealth gap within societies. Furthermore, capitalism tends to prioritize efficiency and productivity, which can lead to the exploitation of labor and natural resources. In pursuit of profits, companies may cut costs, compromising workers' rights and environmental sustainability. This often exacerbates social inequalities, as marginalized communities and workers bear the brunt of these exploitative practices. Another consequence of capitalism is the commodification of essential goods and services. As profit becomes the driving force, access to basic needs such as healthcare, education, and housing can become limited, particularly for those who cannot afford them. This further perpetuates social inequality and hinders social mobility. However, it is important to note that capitalism is not without its merits. It has been instrumental in driving economic growth, technological advancements, and the creation of jobs. It has the potential to lift individuals and societies out of poverty and provide opportunities for upward mobility. To address the impact of capitalism on society and inequality, it is crucial to strike a balance between economic growth and social welfare. Policies that promote fair wealth distribution, protect workers' rights, and ensure access to essential services can help mitigate the negative consequences of capitalism. In conclusion, understanding the impact of capitalism on society and inequality is essential for navigating the complexities of our economic system. By acknowledging its strengths and weaknesses, we can work towards a more inclusive and equitable society that harnesses the benefits of capitalism while mitigating its negative effects. Evaluating alternative economic systems and their relationship with money-making. In the quest to understand capitalism and its intricate mechanisms, it is vital to evaluate alternative economic systems and their relationship with money-making. While capitalism has been the dominant economic system for centuries, there are other models that have emerged as potential alternatives. One such alternative is socialism, which advocates for collective ownership and control of resources and aims to distribute wealth more equally among society. In socialist economies, the focus is not solely on money-making but rather on meeting the needs of the community as a whole. This contrasts with the profit-driven nature of capitalism, where money-making is the primary objective. Another alternative economic system is communism, which goes even further than socialism in advocating for the abolition of private property and the establishment of a classless society. In a communist system, money-making is not the central concern as all resources are owned collectively and distributed according to need. Beyond socialism and communism, there are various other economic models that challenge the traditional notions of money-making. For instance, the concept of a gift economy emphasizes reciprocity and non-monetary exchange. In such systems, social bonds and the well-being of the community take precedence over individual accumulation of wealth. When evaluating these alternative economic systems, it is important to consider their potential benefits and drawbacks. While capitalism has been criticized for exacerbating inequality and fostering a profit-driven mentality, it has also been credited with promoting innovation and economic growth. On the other hand, alternative systems may offer more equitable distribution of resources, but they may also face challenges in terms of efficiency and individual incentives. By exploring and analyzing these alternative economic systems, we can gain a deeper understanding of how money-making is approached in different contexts. This can lead to meaningful discussions and potentially spark innovative ideas for shaping a more inclusive and sustainable economic system. And that concludes our journey into the labyrinth of capitalism, where money begets more money. As we part ways, reflect on how this understanding can empower positive change. Can we reshape capitalism for a more equitable tomorrow? Remember to like, share, and subscribe to our channel for more enlightening content if you enjoyed this exploration. Keep questioning and exploring, and forge a path toward a fairer financial landscape. Until our next adventure, stay curious.